Folks, usually in a normal market, there are lots of variables that go into kind of figure out what's going on with inflation, what's going on with interest rates, what's going on with mortgage. But we live in a world where we're going to get some data tomorrow about CPI, Consumer Price Index, and it will be market moving up or down. If it comes in hot, watch out. If it comes in low, watch out. And oh, by the way, if it comes in negative, which I actually know that headline month on month reading is now expected to be negative, things could get wild in the mortgage market. So let's talk to Matt, the mortgage guy. How you doing, buddy?
I'm doing great, Mike, and you're absolutely right. When there's other economic activity moving, we're looking at multiple things as far as what's going to move interest rates. There's no close second place. The inflation number and following inflation. If you're following mortgage interest rates for the first half of 2023, they are going to basically drive the Fed moves, in my opinion. The Fed doesn't meet this month, they meet in February. But depending on how inflation comes in on January 12th, which is December's CPI reading, it's going to be a big market mover, mortgage-backed securities. The Fed likely will justify what they do or they don't do in February because of what this reading is. And so I'm excited for it. We discussed previously, we know what a dramatic effect rates have on demand. And so, with a lot of demand zapped from the market when we got up into the sevens, rates have creeped down. It hasn't been a straight line, but we're in the low sixes on a 30-year fixed without even paying any points. And people are paying to get a five handle. If we get a low CPI read and inflation looks like it's on the way down, and Jerome Powell can see, his 2% target in the future, it's certainly going to have a positive downward pressure on mortgage interest rates.
Well, I don't even think it's that. I mean, I think it's better than that. There's a gentleman, Jeff Gunlock, I believe his name is, who's called the Bond King, and he's basically saying, stop listening to the Fed. Right? The Fed is trying to build up their reputation. The transitory thing got them. Gunlock's basically saying, watch the 2-year bond. That's where this thing is going. So if Gunlock is right and we get a negative headline CPI reading month on month, which is calling for negative 0.1, the bond market tomorrow is going to be wild. Rates could go down significantly. Now, why is that? Well, that'll just be a sign that what the market will say is Gunlock is right, the Fed is wrong, and rates will crash because deflation is here, recession is here, the world is ending. And if that happens in the bond market, mortgages could see significant drops as well. Again, I'm not calling for it. I'm just saying if this happens, then this seems like a likely outcome to me, right?
Yeah, for sure. And what's that 2-year treasuries, like 4.25?
Yeah, 4.26. I think I checked this morning.
Yeah.
But the 3-month is like 3.7 something or something like that.
Wow. Yeah. I mean, we keep watching this 10-year treasury creep lower and lower, and crazy calls from my buddy Barry Habib where he's like the 10-year will be at 3, and the gap between the 10-year and the 30-year will come back to normal levels, and we'll have a 5% 30-year fixed.
When is he calling that? Does he still think that's by the summer?
I think so. I think like by the end of Q2 was the call, which is, relatively aggressive. Was it somebody on that Patrick Bet David show that was talking too about how they saw a Fed cut in 2023, which I'm fairly certain you're in the opposite camp, right?
Yeah, I don't see a cut. I see them doing 2 little quarters and then stopping all year, right? Big plateau. But that doesn't mean mortgages can't have a 5 on it. I mean, I think it absolutely, they do have a 5 on it. So yeah, it's I mean, just think about that, right? So if Barry Habib is right, and again, I'm just going to play this out with you, right? So let's assume that we have 5.0 30-year mortgage owner occ by June. Let's just play it out. How do we get there? I think we have to have negative month-on-month readings, because what will happen is the bond market will just scream bloody murder that inflation is not a problem, deflation's a problem, and the Fed is behind the curve and the Fed has to cut. Now, will the Fed cut? I don't know. but that's what the bond market will say. And if the bond market, like at the 10-year note, which is, let's call it 3.5 between friends, if the bond market goes to like 2.8, 2.9, and then the spread comes in from whatever it is today, 2.5 to like 1.7, we could easily have a 5% mortgage. I mean, I'm not calling it, but I can see how Barry gets there.
Right, right, yeah, and then you know, there's all these future dynamics you can talk about. You know, where the heck's the inventory going to come from, right? Because it scares me a little bit to think about you know, more mortgage demand coming, and I guess hypothetically, when you think about it, some of those people that are kind of locked, like I've got a 3%, I don't want to upgrade if I'm going to get to a 6.5. If they go from 3 to 4.75. More likely to move, unlock some of that inventory.
I think the big question for the move up buyer, which is what you're really pointing at, is how much payment shock can they eat? So again, let's just play it out. Because again, you were one of these people. You were looking at potentially buying a bigger house. You did the math and you're like, nope, we're staying put. So we already know the answer is if your payment doubles, you're not moving. So we can agree on that.
Mm-hmm.
What happens if your payment goes up 50%? I think most people say no thanks.
Yeah, and you know, it's funny too, because it's like unlimited variables, right? Like, how good is the job market? How good is the economy? How optimistic are people, right? Because that's the thing too, is in certain markets, I might say, you know what, I can handle 50-60% increase in my mortgage because things are going well. In a market where we're like, you know what, we better contract on our spending.
Yeah, we better be more conservative.
Right. Yeah.
Not going. Yeah.
Right. So yeah, that's another factor too. It's fun to, you know, play what ifs.
Yeah.
You know,
so I think we could agree that 50% in payment bump and a weak job market, the answer is no. So then you get to 25% or 20%. I think that's reasonable discussions. So again, somebody who maybe has a 4% mortgage and you're going to go to 4.75, yeah, you probably make that move. But if you're at 2.8 and you go to 4.8, still the answer is no. It's just math, man. It's just math.
Right. Yeah. Then you're just left with the, you know, need tos and not the just want tos.
And again, that if this whole conversation is all about demand, but let's not get it twisted. That affects supply also, because the move up buyer is a listing and a purchase. You're not going to get the listings. That's what I think a lot of people are missing. I'm talking to agents every week. People think that we're going to just get mountains of listings in March, and I don't see it. One of my 12 predictions is the spring selling season lands like a thud because inventory doesn't show up. It's kind of crazy.
Right. Yeah. Which, you know, in markets I'm in, there's nothing for sale. That's the problem.
And it's funny, the stuff that is for sale, what people are starting to tell me now, Michael, the inventory's up, days on market. And I'm like, okay, I'm going to guess in your market, a lot of that is luxury, because we are seeing luxury listings. And again, luxury simply defined as 2x the median. Those are exploding. I just talked to Adrian Hernandez in Orange County. Average days on market for that segment is 100.
Wow.
100 days. Nothing is moving. But then again, you look at Orange County below that, on fire, because there's nothing for sale. So there is no one market. I always talk about entry level, move up, luxury. Luxury is dead, near as I can tell, across the country. Luxury is a want, not a need. A lot of the luxury buyers have wealth in stocks and other things. It's not doing well. The job market, business is not doing well. So everybody is retreating. So yeah, the luxury segment is in big trouble. But first-time home buyer homes, still doing well. Rates come down, still doing well. But I don't know where the inventory is coming from. What do you think?
Yeah, I mean, I think you're exactly right. Where there's just, you know, the inventory is going to be stagnant, and so it's causing this weird dynamic where people are waiting for prices to drop and they're not. Right? Demand is down, and so is supply. Right? And so there's no imbalance where if, you know, a glut of new supply came and people start listing their homes, we might see a 5 to 10 to 20 in some of these markets.
They're not coming.
They're not coming. And so, you know, prices are relatively flat. Stuff is sitting, you know, because the ugly ducklings are the only ones that are on the market right now.
Right.
But
yeah, that in wish pricing.
Right. Yeah. And that to me just continually cracks me up. right? Where it's wish pricing, and then you have a conversation with the agent. The agent goes, listen, I get it. My seller will not take less than this. And I tell
Yep.
the agent, well, take it off the market. It's not going
Yeah.
to sell for that number
That,
they want, because
exactly.
the market's already told them for 94 days that they're not getting
Yeah.
that. I don't know what they're waiting for. But rates could drop 1 full percent tomorrow. And somebody, might make that deal work, but
Yeah.
it's fun stuff, man.
It's fun stuff. We're going to get through this. The good news is one of my 12 predictions in real estate is we are at or very close to the bottom. I call the bottom in transactions about 3.9. Last reading was 4.08. So rough and tough, we are there. We got to get through this year. Let's just build through the foundation and get out of this next year. So Matt, where can somebody find you?
Go to greatmortgagebroker.com. If you're looking to get yourself pre-approved, you want to know your numbers before you're out there, submitting offers. And Mike says it, I'll say it, bears repeating, do the work. And part of the work is knowing the financing for the vast majority of people that are using debt to finance. You should know whether you're getting it at 5.5% or 6.5%, and how much you're putting down, and how much you've got, and how much it's going to leave you in reserve. So do yourself that favor in 2023. Absolutely. If you're serious about buying something in the next quarter or two, or even if you just want a starting point for something you're going to buy a year out. Greatmortgagebroker.com. Get yourself pre-approved, get some good advice from some good folks. We're happy to help.
Yep. And of course, you have a YouTube channel where you've got hundreds of videos answering just basic mortgage questions. What is that?
Go to Matt the Mortgage Guy on YouTube, and I think I passed 700 videos. Nice. And I just keep putting them up. Just keep firing away with questions, because some of the best videos just come from people asking me a question, and I go, you know what? I heard that question before. People must be interested in this. Maybe I'll shoot a video.
There you go. Thanks, buddy. I appreciate all you do. Talk next week.
All right. Thanks, Mike.